Welcome to Not Your Mother's Housing Market, the podcast where we dissect and discuss emerging trends in real estate because a 21st century market requires 21st century strategies. I'm Katie Keaton, your Southwest Washington realtor with Realty One Group Pacifica.
And I'm Gabby Graves, your local lender with Synergy One Lending.
And notice she did not say her NWMLS number.
I didn't. My compliance department said that I don't have to recite that anymore.
I know. So we are really working
Popping bottles.
We're popping bottles.
Popping bottles.
I was going to say we're like working through all the kinks. We're getting going. We're figuring things out.
We are. Yes. It's taken a couple episodes to figure out all the little legalese, fun things we have to put on our episodes and all the fun things we have to say or don't have to say anymore. So just working out the kinks.
Should I tell them about our vases theory?
Yeah.
Okay. So this is before the episode, but I think it's very interesting. This is the YouTube video, the short that I saw that has changed my life. And honestly, Gabby and I are using it as our model for getting the podcast going. So basically,
or just our life mantra.
Our
really.
life mantra.
Yeah, I say it at home.
Listen to this. It's a good mantra. So I saw this online. Can't give credit because I can't remember who posted it originally. But basically, it was a study that happened, and they took a high school pottery class, and they broke the pottery class into two different groups.
Okay.
So half of the class, their objective for the semester was to make as many vases as possible.
Okay.
And the other half of the class, their objective for the semester was to make the perfect vase.
Okay.
So one, it was about making as many as possible. The other, it was about making the perfect vase. So then in the video, I'm watching this. I'm like, yes, I love a good study. Love to hear about, science, statistics, those sort of things. And so the question was posed at the end of the semester, who do you think made the best vase? And me, being a school person, an academic, I was like, oh, definitely the people that they were supposed to make the best vase. But no, it was the group that made the most vases.
Yes.
Because you get better at things by doing them.
Yes.
So it was like their first vase wasn't very good,
Okay.
but their last vase was better than the other group's vase.
Exactly. Because you have to put in the time.
Yes.
Right.
Exactly. So that's kind of like with this podcast. We've been talking about doing the podcast, and I was like, oh, when are we going to start? We don't have every duck in a row. But then it's like, it's okay because every single one of these episodes is a vase.
And I sometimes stop myself from even starting because I want to have all of my questions answered first. I want to have everything checked off, everything organized, all the right equipment purchased. And it's like, no, honestly, we should just rip off the Band-Aid.
Make some vases.
You learn more as you go. Truly.
Yes,
that's
truly.
how you learn. So that's our mantra, vases. Whenever I'm doing something at home, vases. You don't need to re-clean this when you're, maybe your significant other or, whatever, folded the towels wrong.
Oh,
you don't need to refold the towels. Vases. Just put them away.
Vases.
Just put them away.
So was that informative to your life, Wayne? Yes. Did you learn a little something from that?
Very much so.
Okay,
Good.
great.
Yeah.
So anyway, think of this podcast as a vase, and we're just making vases together, and you are learning a little bit about the real estate market.
So it may be, a little misshapen and leaky right now, but we're going to get it there.
By the end, we're going to be like master sculptors. Get it? Did you get the analogy?
I did.
Okay, cool. So this week's episode we are super excited about, honestly.
Yes.
We picked it, I don't know, a few days ago, last week, and I was pumped. Like, I was feeling the synergy of it. So we are going to talk about the impact that such low interest rates during the pandemic are having now on the current market. So kind of how we're thinking about it is, if you watch anything real estate related, if you know a realtor, if you know a lender, you may have heard the term date the rate, marry the house.
Right, which means rates are temporary. What you actually pay for the house or the actual home itself and where it's located, that's permanent.
Mm-hmm. So kind of the idea, and when people say that or when the rates are high. So you might be hearing people say, oh, you're just dating the rate because it'll change.
Right.
Well, all those people that got crazy good interest rates are potentially staying in abusive relationships because now they are married to their low interest rate.
Why does it have to be an abusive relationship?
Maybe it's not abusive.
It could be a healthy, well-communicative,
Well-communicative.
Is that a word?
I don't know.
Wayne, edit that out if that's not a word.
No, keep it in. Keep it in.
But I mean,
Yes.
but yes, these people are stuck.
Yes,
they're
these people are
choosing to
stuck.
be stuck. It seems like. I mean, I have heard people, friends of mine who refinanced in the last 2 years, and they've said phrases such as, "You're gonna have to drag my cold corpse out of this house," because they don't want to change their housing payment and they don't want to change their interest rate.
Yes.
Right.
So yes, that's what we're going to be talking about today. All those people who were so lucky and got record low interest rates, what impact is that having on them now?
We applaud you. Congratulations.
I'm jealous.
But I'm jealous. But what are the ramifications of that? And how is that affecting our housing market now? And people who are looking to buy now, people who have those record low interest rates, how is it affecting them and their future plans?
And how is it impacting the market in general? Because one big thing that's happening, and we all know this, is we have a severe housing shortage.
Right.
We've had a severe housing shortage for a long time.
Decades.
At this point, decades, yes. Builders are afraid to build. They don't want to get stuck with half-completed houses, as the market continues to go up. It seems every year is like, oh, but the market's about to crash. So as a builder, that's a huge risk because the building process takes months. So you don't want to be left holding the bag if something like that were to happen.
Right.
And that's been a big part of why we've had such a shortage in the housing market. And that creates increased prices. So, I was looking at an article from CNN Business, and it was just published on March 8th of 2023. And it's basically saying we are several million houses short of what would actually
Meeting current demand of what of new buyers.
Thank you for bailing me out of that. Basically, we have a huge housing shortage. Millions of houses short.
Multiple million?
3?
Wow.
Yeah.
Wow.
2.3.
That is.
Yeah.
That's not a fun number to think about.
Yeah. So we need more houses.
Okay.
And part of that is people selling their homes.
Is that based on current numbers, current need, or is that a projection of future need in the next 10 years or something?
I believe that's current need because a lot of the times what people say is and don't quote me on this again, vases. But, for a balanced market, you have 6 months of inventory in houses. If not a single house came on the market for 6 months,
Right.
It would take that long to sell all of the homes that were actively available. So that's usually what we base things on when we say a balanced market.
Okay.
So we've had a shortage of inventory for a very long time now.
Interesting.
So I'm assuming that's what they're basing it
Referencing.
off.
Okay.
Yes. So yeah, you were reading an article earlier, and they referred to this as the golden handcuffs.
Right, that many Americans want to move but are trapped in their homes due to these record low interest rates. And they feel like they have these golden handcuffs keeping them where they're at. Some people, the article is from the Wall Street Journal, written by Nicole Friedman. It was updated on May 10th of 2023. They cite that a lot of people want to grow their family, or their family has grown and they want to increase the size of their home, or even that people want to take advantage of climbing the corporate ladder, moving up the chain and taking a promotion that might result in a move, but they reject those opportunities to grow their family, to grow their career, because they are scared of the impact moving will have on their monthly mortgage payment. And it is keeping them handcuffed, if you will, to the existing home they're in.
So can you give us an idea just about the historical significance of how low the rates were?
Yeah, let's see here. I have an article we pulled up
We have
and we
so
looked
many
at
articles
together.
going today. We are just, professional ladies.
Just regular old news anchors. over
Professional
here.
ladies.
Okay, so this article is from NPA.com. The article is titled Historical Mortgage Rates in the U.S., Highest High and Lowest Lows. Go for ask
it.
your question again.
Well, so I was going to say, we got down into the mid twos during 2020, 2021, 2022. Right. And so that really was when people say, oh, historic lows, that's the lowest they've ever been since Freddie Mac started keeping track of mortgage interest rates back in 1971.
Correct.
Which, by the way, I was trying to find a super like long ranging graph of mortgage interest rates, and I was going crazy because every single article was like, oh,
1971
since 1971. It was driving me insane because I'm like, I want to hear about like 1920s
or even like the 1950s and 1960s, you know, when it seemed like our economy boomed off of, you know, a one income household. I was interested to see what rates were at that time,
which I'm sure we could have dug further, but everything kept coming back with 1971 because that's when Freddie Mac started keeping track.
Correct.
Yes. So a lot of these numbers are going to be based on that. So keep that in mind. But basically, there has not been a time that interest rates were so low since 1971. The lowest they got was mid threes, and that was around
2016, right?
2012. I think it was just basically the 2010s, which what are we calling those? The 2010s?
2010s is what it's referenced as in articles.
Teens?
I think it's weird.
I'm going to keep saying that. I think that's
I don't
cooler.
feel good about either of them.
The teens. I don't feel good about either of them either. The 2010s.
I still feel like I'm in the 2010s.
I feel like it's 2000. I'm 10 years old listening to NSYNC.
Yeah.
Which we were singing earlier.
I mean, don't we all wish it was like, or the 90s?
Don't we all wish?
I mean...
Don't we all wish?
Yeah.
Okay, so anyway, they were in the mid threes. And even that was like historic lows. People were hooping and hollering.
Right.
But, you know, they have been all the way up into the 18 percentage points.
Right. So, like, just to recap a little bit. So, going back to, like, the early 1970s, when Freddie Mac started basically collecting this data, this article states that interest rates were around 7.29 to 7.73% in 1971. In the early 80s, they climbed to about 9.5, they climbed in the, one moment. In the early 1980s, they continued to climb, and they went all the way up to 18.45%. So early 80s, we were seeing 18% because we had record high inflation as well.
Yeah. So then from the 80s to the 2010s,
they started dipping down in the 90s. They started dipping down
and went all the way down to mid threes.
Right.
And
so
then,
in the 90s, we were seeing like early 90s, I think we were seeing like double digits, it's saying low double digits. But in the mid 90s to late 90s is when we started seeing things get closer to 8%. The early 2000s, we started seeing things creep into the sixes, and that kind of stayed our norm. That 6% and lower kind of stayed our norm through the 2000s, 2010s until we hit the pandemic. And that is when things went to an all-time record low and people were refinancing into, you know, threes, even sometimes mid twos.
So with that in mind, it's understandable why people want to hold on to those really low interest rates. They've only been in the mid threes, you know, one other time historically since 1971 before this. And there really is no, you know, any mortgage person you talk to, any realtor you talk to, yes, interest rates will probably come down. They do fluctuate. We're dating the rate, as we say.
Right.
But the chances of them going back to the mid twos again are extremely low. And part of that was because they really were artificially placed there. So could you talk a little bit about that? Yeah.
So during the pandemic, the Federal Reserve decided to do massive cuts to the Fed rate. They basically wanted to spur spending. Because our economy was shutting down due to the pandemic, they wanted to make it easier for individuals as well as business to access cash so that you weren't going to see mass layoffs. You weren't going to see mass foreclosures, things like that. So to make it more accessible to borrow cash, they decreased the interest rate all the way down to 0%. The Fed's fund rate, which is the benchmark short-term lending rate that financial institutions use, was all the way down to 0%.
So basically the Feds were like loaning money out for free so that banks could loan out money for 2.5%.
Exactly, to help keep our economy going. Because at this time, you have to remember, you know, it feels foreign now being out of it 3 years. But at the time, nearly all businesses shut down. And so you have, you know, we had large layoffs, especially in the service industry. But even in the non-service industry, there was a while people were trying to decide, are we an essential business or not? And they closed down for a while. And so making this money, you know, extremely cheap to borrow is what kept our economy flowing. It also, long-term, has fed inflation that we are now paying the price.
Right. So, it was a good thing it was keeping our economy going, but maybe those artificially decreased rates lasted a little bit too long. You know, people were purchasing at those really low rates, but we haven't talked about the gigantic refinancing boom that also was happening at the same time. So that same Wall Street Journal article actually mentioned that since March 31st of 2023, 2/3 of primary mortgages, the interest rates are below 4%.
That is fascinating.
That is fascinating.
66% of all current mortgage holders as of March 31st of this year have 4% or lower in an interest rate.
And I believe that's on their primary residence, but yes.
Yes. So that kind of shows you, 66% of those people of current mortgage holders, they are looking at current rates and current mortgage payments and kind of thinking, I'm happy where I'm at. You know, maybe I'll reno that bathroom and that kitchen or throw up some wood paneling like Katie suggested.
I love wood paneling. It is back in, you guys.
Okay. We're going to bring in like an interior design person as our next guest and ask them if wood paneling's in.
They will agree with me. Okay, write that down, Wayne. We are bringing in an interior designer.
We are.
Wood panel conversation.
We are.
I am telling you, it is back in.
Yeah. I have someone in our office.
Yes.
Yeah, I'm going to ask the ladies.
Okay.
Yep. Okay. Interior design.
Okay, so stay tuned because that'll be up next on one of our episodes.
I think we should place a bet.
I would love to place you a bet on that.
I think we're going to place a bet.
I have been
Lunch
in there
at
before.
Siam. I say wood paneling is not in.
I said wood paneling, first of all, yes, it is in. But I said that within the next 5 years, it's going to be fully in.
Okay,
So
but
that's what we're
shiplap doesn't
asking her.
count.
I'm not saying shiplap. Shiplap is
okay.
going out,
No,
girl.
agreed. I'm just saying I'm trying to draw a hard line on what we're saying wood paneling is.
And we are betting lunch at Siam Spice.
Yes.
Okay. And I'm getting
There's not a chance
2
in hell.
entrees when I win. Okay, it's for 5 years though. So, okay. Anyway, so maybe people are throwing up some wood paneling to be happier staying in their house longer.
Right.
You know, even myself, first of all, I will just say I missed kind of the refinance boom. I had luckily recently refinanced, so I'm in the mid-3s, but I wish I could have refinanced even lower into the 2s, but I hadn't been a realtor long enough, so they couldn't count my income, blah, blah, blah.
Darn self-employed people.
But I don't want to give up my interest rate. And we feel like our house, we would love a little bit more space. We've even talked about adding on to our home.
Right.
Adding another bedroom to our home. Luckily, we have the property that we have a little bit of leeway into that. But it's like that to me would be a better option than trading up.
Right. Because right now, people are nervous about that monthly mortgage payment, essentially. So, Katie and I looking at an amortization calculator. So by no means am I quoting rate right now. I'm not quoting what rate you could get or what rates other people have. That obviously is dependent on your application and specific to you. But just looking at interest rates increasing 3%. So looking at those COVID rates compared to what they are now. So if we're just looking at...
And that even is a little bit, you know... Some people might be looking at a 4% difference. Like
maybe.
Yeah. So we're even being a little bit conservative with this. So the difference in like a 3%
right.
swing.
So if you're looking at, say, a $300,000 home, right? Or just a $300,000 home with a minimum down payment, say 3.5%, you would be looking at, if an interest rate increase of 3% occurred, your purchase power is decreasing by $553 a month, meaning your principal and interest portion, or just the interest portion alone, since we're talking 300,000, we're comparing apples to apples here. And the only thing that's changing is that interest rate going up 3%. Your monthly mortgage payment is now $553 a month more on a $300,000 home, a loan of $289,500.
Yes, and that is even if you can still qualify for that much. That's even if it's like, okay, will the bank even, or will the lender even let me go up $500 in my mortgage payment? Because a lot of people are purchasing towards the top end of what they're qualified for. Right. So that might make the difference between you being able to get that house or having to settle for less.
And what Katie's discussing right now is what's known as the debt to income ratio. So your debt to income ratio is measured by the sum of your minimum monthly payments that are reported on your credit report, in addition to the total estimated monthly mortgage payment on the loan you're trying to get approved for. We add all those minimum monthly payments together and we divide it by your qualifying income. So that debt to income ratio, like Katie was saying, a lot of people, you want to get pre-approved for the max, if you will. Not everyone wants to spend the max, but they want to know, what is the top that I can buy at? Well, if you're really shopping in that top bracket of what you can afford, when rates go up, what you can afford directly decreases.
Right.
Because your debt to income ratio is impacted by these interest rate increases.
Right. So that's a huge difference.
Right.
And currently, as of May 4th, Freddie Mac said that the average mortgage interest rate was 6.39.
Correct.
Yes. I think we got that from the
Washington Journal.
Wall Street.
Wall Street Journal. The Wall Street Journal article, yes.
The Washington Journal would probably agree as well, so it's fine. But yes, from the Wall Street Journal. We just want to make it very clear. We are not actually quoting any rates to anybody, either Gabby or myself, but we do want to give you an idea of like what that difference looks like, which
we're
is
just
a
talking
big
math.
difference. We're just talking
math here. Straight amortization calculation. This is what this is how the numbers change.
Also, can we talk about amortization? Because I thought it was amortization for years.
Oh, wait, what? You thought it was what?
No, amortization. I'm like, amortized. And
that sounds
like
something you do at the morgue.
Oh, true.
Like a coroner would do. They would amortize people. That's what that sounds like to me.
Well, people might want to get amortized when they see what their monthly payment is going to look like.
Yeah. Katie. Amortization.
Anyway, okay, so
such a fun
people
word.
are wanting to hold on to their rates, and that is directly correlating with people staying in their homes longer. So
even if they don't want to be, they're willing to. It seems like people are willing to sacrifice other advancements in their life not to disturb their set monthly mortgage payment they have right now.
Yes. Okay, so thezebra.com.
Ooh,
I looked up an article and it says the average length of home ownership. Americans spend less than 15 years in one home. So 15 years, but that's a long time.
That is a long time.
As a realtor,
I would have thought it would have been a lot less, especially when you think about people just growing their families or just that next stage in life, growing their career. 15 years sounds like a long time.
So again, this is the median, which I'll get into my thoughts about medians in a second. But basically, that sounded really long to me when I was looking at it because as a realtor, when we are getting coached about like, okay, who is most likely to sell their home? I think this kind of goes back to Not Your Mother's Housing Market, where the old adage was that people stay in their home 5 to 7 years.
And I really still believe that.
Yeah.
Huh.
So, but it is increasing, which makes sense. So it looks like, so the average length of home ownership is 8 years. And the median time spent in the house is 13.2. So if you were to do the mean average, it's 8 years.
Okay.
Which is a little bit closer.
That makes way more sense.
But the median is 13.2 years, which... Again, medians. I hate medians.
I'm going to open you up to this.
I will always deny on because I hate medians so much. So let's go back to what even is it? 4th grade math?
Yeah, let's define this real quick. What is the definition of the mean, Katie?
So the mean is the actual average where you are adding everything up and dividing it by the number of items you are adding up. So that is the mean.
And what is the mode, Katie?
The mode is the number that shows up the most. So you look at every single number and the one that shows up the most. So this one, obviously, we'd never use because it's like one house might be like 359,000. One house might be 360,000. They're basically the same, but they would not show up on the mode.
Got it.
But the median is if you were to plot every single house price or whatever you're plotting
on a graph,
on a line chart. And then you just say, okay, there's 50,000 on this side and 50,000 on this side. What is the one in the exact middle? And that is the median. And I just hate that we use median for everything. I'm sure there's a reason why, but even in stats class, I was like, I hate median. So anyway.
Yeah, it doesn't.
The average is 8 years. The median is 13 years. But regardless, that has gone up almost 30% since 2012.
Wow. So in the last 10 years, that's gone up 30%.
Yes.
Wow. And what do you think that's directly correlated to?
I think it goes back to a lot of what we were talking about, because 2020, 2021, those were historic lows, but 2012 was historic lows.
In purchase price?
No, in interest rate.
Oh, in 2016. Right.
Well, even in 2012, we did go back and it was...
Let's go back and look.
Go back and look. Go back and look.
Oh, yes. In 2012, they were going back down into the 5s and in the 4s.
Mm-hmm.
Yes. And then 2016, they reached mid 3s.
Yes.
Yes. So as well as home prices were lower.
Yes,
and
they
I
were
think
historic as well.
That's a huge part of it.
Mm-hmm. So I think people are holding on to those interest rates. And I think that is a huge part of it. And I think we're going to see it more with 2/3 of people in their primary residence having interest rates of 4% or less. Especially, you know, a lot of mortgage lenders, and correct me if you think you don't agree with this, but I've kind of heard that it's like if you can get 0.5% off of your interest rate, it kind of makes sense to refinance. I mean, I think it depends on other things as well, but when I was going to refinance, it's like, oh, can you get 0.5% better? Then yeah, let's look into refinancing at least. Well, we're not talking...
I think it depends on your situation.
Totally.
Right.
But we're not talking about 0.5%. We're talking about whole percentage points that people are differing.
Right.
So that is really scary.
Absolutely.
So I do think we are going to see people staying in their homes longer. So we have talked also about, you know, those people that like lucked out. Like my dear friend, who was the very first home purchase I ever helped with. She purchased in 2020, I guess, and she has a great interest rate and she has an awesome house. She has the best house. And I was actually over there the other day because it was her birthday, and her and I were just talking about how she loves her house so much. And she's literally, you're going to have to pull her corpse out of her house because she is never selling it. She has an awesome interest rate. It's in the 2s. Yes. She loves her home. She is never leaving. And that is awesome for her. But that is not everybody's story.
Right. And it makes it hard for new buyers.
Well, not only does it make it hard for new buyers, but it does make it hard for those people who purchased and it was never supposed to be their forever home.
Right. Yes, I agree with that. It was supposed to be their starter home, and now they're potentially stuck there for the next 8 years,
right,
on average.
So the reason why they say like 5+ years to buy a home is because usually that's how much time it takes for you to like make up enough equity for it to make sense for you to move. And equity is still existing in houses. Equity is still up over the past 2 years, but not enough to really offset that huge change in interest rate. So talking about those people where, you know, they purchased a home that maybe is 2 bedrooms and now they've had a child or 2. Or they purchased a home and they decided that they didn't like something about the house. Maybe they hate the yard. Or maybe they realized the street was too busy.
They hate the neighbors. No, I'm just kidding. Sorry.
I mean, that happens sometimes too. They're the ones that are looking at their options and thinking, wow, I did talk to a mortgage lender. I've talked to a realtor. I've looked into what it would take for me to move into something else. And I don't know if I can afford that jump. So those are the ones that have that golden handcuff.
Yes.
But people are still selling. People are still buying. So kind of talking about who is doing that. You know, there are people that just genuinely hate their house so much that they will sell it no matter what. The people that are relocating potentially to a cheaper area of the country, they're still able to sell their home.
I'm hearing that a lot.
Yeah. I met with a couple the other day, and they are thinking about relocating. And for them, it made a lot of sense because they can sell their home here and just purchase something with cash in a different area of the country where things are much more affordable. Right. So, you know, for them, it makes great sense to sell their house, even with the interest rates being as different as they are. You know, maybe someone is selling and they're moving in with family. Like maybe they're of an older age and they're transitioning to a different phase where they don't need to buy a house. Or maybe they're selling and they are moving in with family, but it's just because they don't want to be in the housing market right now, or they're going back to renting. We honestly are seeing that as well. Maybe they have a job change and their difference in income is enough to offset the difference in mortgage payment. Right. So those are the people that are still, it's pretty easy for them to sell. And I would also say another group that can still sell fairly easily are those refinancing group. that those people that purchased, maybe they purchased in 2016, 2015, 2012, and they also refinanced. So they have a load of equity on top of the good interest rate. Their equity is enough to offset the difference and to move up the property ladder. Would you agree?
Yeah, I would agree. As long as, one thing that was really tempting for people, I think, during COVID, during those low rates, is some people who refinance, they pulled cash out. So that's one thing to factor in too. People were taking advantage of that, which I think that's a great opportunity. But a lot of people were taking advantage of that for investment reasons. Building additions, buying second homes, a lot of people were taking out that cash, deciding to use it for other things, reinvestment into second purchases. So it just depends.
It does just depend. Yeah. And I think, house prices have come down slightly from where they were when the interest rates were so low.
I agree. Compared to before, as far as I represent buyers. I don't represent sellers and buyers like you do. But from what I'm seeing, my buyers are not having to get in the same bidding wars that they were and go over ask price like they were during COVID.
Yeah. Yeah. But there's not that much where it's like people in 2 years have gotten enough equity to like sell and purchase something else.
Agreed.
And if they are, it's like a straight across, it's not moving up.
No,
really.
It's just trading one for the other. But now you have a much higher interest rate.
Right. So, this has been a really interesting topic, and I do think it is good to, kind of forecast into the future. Like we saw these historic rates and they were awesome for the time, but what does that mean moving forward? It doesn't mean you can't sell your house, but it definitely means that you need to put a lot of strategy and thinking into the beginning phase of the selling process instead of waiting until you've already made up your mind about selling and then figuring out what you're doing next. Another option that we've kind of talked about, and I've seen some things online where people are becoming accidental landlords.
Yes.
And
turning their primary into a rental. Yes.
Yeah. So, maybe you've lived in your home 2 years and now you can purchase something else and that will be your new primary resident. And you can turn the home that maybe is a little bit too small for you, but has a great interest rate, has still a great mortgage payment where there is room to make some money on rent, kind of becoming those accidental landlords, which is going to be very interesting moving forward as well.
It will be very interesting. And that will help get more buyers into the market, but not more listings. And so will that help create more demand with more of a shortage?
Right.
We'll see. And I will caution, if that interests you at all, I would talk to a lender first, possibly me, to see what you would need to do first to be able to turn your existing primary into a rental, so that you could use that rental income in an application so that you're not having to count like 2 mortgages against your debt to income ratio. So before you make that jump and make that decision, I definitely would suggest talking to a lender to figure out that path forward and how long you would have to rent for, how much rent you should probably charge on that home, so on and so forth.
And I think that kind of always is the big takeaway because the market is changing so fast.
Right.
And, the advice of your parents may not be applicable to what is happening now. What was really terrible is when people get themselves stuck in a situation where they have already tied themselves to the sale of their home and they don't know what's coming next.
Right.
So again, as always, but especially if you have one of those really low interest rates, but you are interested in seeing what's next for you, absolutely reach out to us, reach out to a lender, have those conversations about what creatively you can do and what makes sense for your long-term financial goals.
Right.
But also your long-term, quality of life. It's not all just about finances. If you need to move out of that house, you have to weigh those quality of life benefits as well. And having a realtor, having a lender who can walk through those with you is not just seeing you as a number, but also taking into account what you need, your life goals as well as your financial goals is extremely important.
Right. And having a plan before you take the jump is huge. So we want to help create that plan for you.
Absolutely. So I hope you learned something today. I hope we didn't scare you too much. Those interest rates were great when they were going on, and there are still ways to to release yourself from the golden handcuffs, if you will.
Yeah, absolutely. And one thing I feel like that we've learned researching for this podcast is while rates are higher now than they were during the pandemic, they're not all-time highs. Our country has seen far worse rates, and people bought homes during those rates. You can still buy a home right now in this market if that is what you choose to do, if that meets your goals.
You can still buy a house. You can still sell a house. We would still love to help you buy a house or sell a house.
Yes.
And with that, thank you so much for listening to this episode of Not Your Mother's Housing Market. Be sure to tune in next time to find out who won the bet about the wood paneling.
Yeah, it's going to be me.
No. So make sure you follow us on Facebook, Instagram at Not Your Mother's Housing Market. And you can also send us an email if you are interested in chatting with us. And that is notyourmothershousingmarket@gmail.com. Until next time, I am Katie Keaton, your Southwest Washington realtor.
I am Gabby Graves, your local lender.
And thank you for listening.
Have a great day.